Hey everyone, and welcome to this explainer. I am seriously thrilled you're here today because we're going to unpack a concept that basically shatters conventional financial wisdom. We spend so much time staring at spreadsheets, projecting out our futures, and calculating what we think is going to happen based on these typical standard models. But what if I told you that the specific order, like the exact sequence in which you experience your investment returns, fundamentally alters your entire financial destiny? It's wild, but it's not just about what you earn over a lifetime. It is entirely about the chronological order in which those earnings actually happen.
So let's dive right into this with a question that honestly sounds a bit like a bizarre math puzzle, but it's actually the core reality of long-term planning. Can two investors have the exact same average return, but end up in completely different financial universes? Well, our brains naturally want to say, no way. If the average is exactly the same, the destination's got to be exactly the same, right? But the reality here is that identical averages absolutely do not guarantee identical realities. And honestly, relying on that assumption is exactly where so many well-laid plans just completely fall apart.
Which brings us to Section 1, the dangerous average myth.
Our source material points out this really stark reality. The average return is a dangerous myth to plan a life route. Now, why exactly is it a dangerous myth? Well, because an average is really just a mathematical smoothing mechanism. It takes all the spectacular peaks and the terrifying valleys, mashes them together, and draws this flat, comforting line right through the middle. But look, unless you're literally a spreadsheet, life doesn't happen on a flat line. Life happens in those peaks and valleys. When you build a life plan, especially a retirement plan, based purely on a standard mathematical average, you're essentially building a house on a foundation that doesn't actually exist in the real world. You're kind of pretending the volatility isn't there, when in fact, the volatility is everything.
And that brings us to what's called the sequence of returns risk. So, this is the phenomenon where the specific order of investment returns changes everything about your outcome. The absolute key word here is order. It's not about the total amount. It's not about the historical average. It is all about the order. Do your bad years happen early on, or do they happen way later? That one simple shift in the timeline holds this immense, truly uncompromising power over your overall financial survival.
Let's see this in action in Section 2, a tale of two investors.
Okay, let's anchor ourselves on an absolutely crucial mathematical baseline, 0%. That is the exact difference between their average returns. Both Investor A and Investor B experience the exact same highs and lows over their timeline. So when they look back at the very end of their lives, if they were just looking at the basic math, they'd see the exact same percentage growth. On paper, they're basically mathematical twins. Whatever happens next, keep in mind, the average return never changed for either of them. The only absolute variable that actually changes here is chronological timing. Picture this. Investor A pops the retirement champagne in year one, and bam, the market immediately tanks. We're talking a brutal bear market right out of the gate. Now, Investor B experiences that exact same market crash, the literal exact same percentage drop, but they don't hit it until year 18 of their retirement. So it's the exact same crash, just experienced at completely different stages of their timeline.
Now, for Investor A, hitting that bear market in year one means their portfolio shrinks massively just as they start pulling money out to live on, because they actually have to sell off shares while prices are at rock bottom just to get the same amount of everyday cash. They are left with far fewer shares to capture the eventual market rebound. They essentially permanently destroy their ability to bounce back. But then look at Investor B in year 18. They've had 17 years of compounding growth beforehand. Their portfolio has expanded, it's strengthened, so when the drop finally happens, they've got this massive cushion to absorb the blow, even while they're taking money out.
Because of this timing, the math completely breaks down the whole illusion of the average. Investor A ends up in one financial universe, likely running out of money, constantly stressed, and just watching their nest egg spiral down to zero. You just cannot easily recover from a massive drop if you're also aggressively withdrawing funds early on. Investor B, meanwhile, ends up in a completely different universe. They thrive, they have abundance, and again, they had the exact same average return over their lifetime. But the sequence of those returns, literally just that timing variable alone, sent these two identical investors into completely different realities.
Moving right along to Section 3, the ultimate risk factor.
So here is the really massive takeaway from our source material. The date you retire is a risk factor all by itself. Seriously, think about that for a second. We spend so much time worrying about what specific assets to hold or, what the inflation rate might be. We treat those as the main risk factors. But the simple, completely arbitrary date on the calendar that you choose to stop working carries massive independent risk. If you retire in a year right before a market downturn, your sequence of returns is going to be incredibly challenging, regardless of how perfectly calculated your average is on that spreadsheet. The calendar date is a variable you just cannot completely predict. yet it has this oversized, defining impact on your final destination.
So, I want to leave you with this pretty provocative thought to carry with you today. Take a really hard look at your own strategies, or maybe the strategies of those around you, and ask, are you planning your life around a mathematical myth? Are you trusting a flat average to save you when you should really be preparing for the sequence? Because understanding this difference is exactly what separates simply surviving your financial timeline from truly mastering it. Thank you so much for joining me on this explainer today. Keep questioning those averages, respect the sequence, and I'll catch you next time.